selling expensive inventory and not making much profit. And let's tell the shareholders that we're on a FIFO system and we're selling cheap inventory and making huge profits and therefore deserve very big bonuses for the year. Well, a good American company operating nationwide has to keep at least 52 sets of books anyway, one for every state that it operates in, unless the state doesn't have any income taxes, one for the federal government for its tax purposes, and one for financial reporting, where we're going to use a FIFO system to report big profits. So understand that companies do keep more than one set of books. Incidentally, if you want to know how to know that, look over on the other side of the balance sheet, which we'll get to in the next session, and discover whether there's a deferred tax item over there. If there is, it means they're keeping more than one set of books. I'll explain to you later how this comes off. So, okay, inventory valuations are complicated because we have to decide how to value the inventory that we're selling. Matching cost to revenues is one of the big problems that all accountants face. Because you see, very often we incur cost in one year and generate revenues by selling the item in a future year. The result is that we have to do the matching to figure out whether we made a profit. Now again, we're not only interested in how much inventory we have on hand, but how many days. How long is it taking us to get rid of this stuff? Because some inventories have a time value attached to them, like a consultant to a pharmaceutical firm. All of the materials they sell, the pharmaceuticals, are dated. And if it goes stale, you throw it away. Perhaps an even closer to home example is the inventory of dresses in a department store at Macy's. At the end of a season, what's a woman's dress worth? Well, an accountant would tell you probably zero. It gets called a rag at that point because it can't be sold. It's out of style. Or at best, it has to be sold at a discount. Well, given this problem, we have to know how long the inventory is lying around in order to get an idea of how stale it is. And the formula that we use is on the screen now. Parallels the formula that we use for days of receivables. Basically what we say is that days of inventory are equal to the inventory on hand at the end of the year divided by the cost of goods sold. And the reason we use cost of goods sold rather than sales are that inventories are valued at cost, and so we want to compare it to the cost of the materials that are being shipped out the door. And you'll find the cost of goods sold is the second line on XYZ's income statement. What percentage of the cost of goods sold is still lying around in inventory at the end of the year? Well, let's take a look at XYZ for the year 1995. The inventories on hand at the end of the year were $6 million. And if we go to the income statement, we find that the cost of goods sold to generate $100 million worth of sales was some $60 million in 1995. In other words, 10% of all the inventory that we shipped out the door that year are still lying around as inventory at the end of the year. 10% of the cost of goods sold is sitting there. 10% of the cost of goods sold for a year, or another way of saying that is 10% of a year of 360 days. So again, we find that the days of inventory on hand for XYZ is also 36 days. Now, is that good or bad? Well, now you'll learn the appropriate answer to all financial questions, and that is, it depends. The answer to every financial question is always, it depends. And if you want to look good in front of a prof, always tell them that. Why does it depend? Well, let's suppose inventories are up over last year. We have more days on hand than last year. Last year, let's suppose we only had 20 days of inventory. Well, at first glance, we could say that's bad. After all, it may mean we did a bad sales forecast, overproduced, and now we're stuck with a lot of stuff that's going to become rags at the end of the season. That's one possibility. Of course, another possibility is that we were anticipating a price increase on the part of our vendors, and in order to beat that price increase, we bought a lot of extra raw material and we're carrying it in inventory, and as a result, we're going to have low-cost inventory to sell instead of the new higher-priced inventory. That would be good. Another possibility is that we were afraid the vendor was going to take a strike and we wouldn't be able to get deliveries, and so to avoid stockouts, we boosted up our inventories ahead of the possible strike. So you see, the answer to whether we have more or less days and whether that's good or bad is it depends on the situation. And what you're really looking for is an explanation. Now, you notice I compared, at least rhetorically, this year's inventory with last year's. That's an important part of analyzing financial data, and we'll be doing that again and again. This year's data by itself doesn't tell us much. What we have to do is compare this year to previous years. And it's probably a good idea to compare this year's data to our competitors, because that will give us a feel for whether the number is appropriate or inappropriate. Numbers by themselves mean nothing until you bring a set of expectations to them and a set of questions. Why are they different? The answers to those questions help give the numbers meaning. The next most liquid asset on the balance sheet, and it turns out that XYZ has some of them, I labeled other current assets. These are assets such as prepaid expenses. It may be possible that we paid for something in advance. Perhaps we paid a month's rent in advance for a new office that we're opening. That's an asset. The ability to use that office now rent-free because we've already paid for it is worth something. So we would put that on the books as another asset. And I've introduced still a new word, current. A current asset, and all the assets we've discussed so far, cash, receivables, inventories, prepaid expenses, are current assets. These are assets that we expect to become cash, to become fully liquid within the next accounting period, that is, within 1 year. If we expect an asset to become liquid, become dollars, within 1 year, we label it a current asset. All other assets are called fixed assets, and ultimately we expect them to become cash too, except we think it'll take more than a year. And so now we turn to the subject of fixed assets. A fixed asset is a non-current asset. Typically, it's either plant and equipment or other kinds of long-term investments that the company makes, again, with the intent of generating more cash than they paid for the asset in the first place. The typical fixed asset for most businesses is plant and equipment. If we buy plant and equipment, though, we know that sooner or later it will either wear out, or the process for manufacturing will become obsolete, or the product that it was meant to produce will become obsolete. So sooner or later, the plant and equipment will also become worthless. And therefore, to be conservative, it's perfectly appropriate that we should write down the value of that plant and equipment over the expected life, the useful life of the equipment. And of course, that creates still another problem. And that is, how do we know how long it's going to be useful? And what formula should we use for writing it down? Now, the general formula for depreciation charge is on your screen. That is, we simply look at what the historical cost of the asset was. We subtract from that the salvage that we think we can claim at the end of the period. If we can scrap the machine, maybe we can sell it for scrap metal. So we get a little bit of money back. Sometimes it still has some useful life. Maybe it was an automobile that's now 3 years old, but we like to drive new cars, so we sell it. It still has some worth, and so its salvage value is whatever the market will bear at that point. And we divide that difference that we have to recover, the difference between historic cost and salvage, by the number of years of useful life that we estimate the product will have. And each year we charge off that much depreciation as an expense, which helps to reduce our reported profits and allows us to pay less to the tax collector. Ben Franklin would be proud of us. The trouble with this formula is that we call this straight line depreciation. We charge off the same amount each year. Probably your experience has been that stuff doesn't depreciate that way. If you buy a new car, does the value of the car drop a lot or a little the first year? The answer is clearly a lot. Anybody who tries to sell a one-year-old car discovers that to their dismay. It drops a little bit less the next year, but still a pretty substantial amount. And the third year, a little less. We could approximate that by using a system called accelerated depreciation. We'll tell the tax collector that we expect that it loses a lot of value in the first year, it loses a little less value in the next year, and then each following year it will reduce the depreciation charge and charge less and less depreciation. Now, what's the advantage of this? Well, what it means is we get to charge a lot of depreciation in the early years, which means we pay less taxes in the early years. However, it also means we'll pay more taxes in the later years because having charged off a lot of the depreciation, we don't have too much left in year 5 or 6 to charge off. But the result is a tax situation where we pay less taxes now and more taxes later. And Ben Franklin would be very pleased with that idea, because when would you rather pay the tax collector? Now or 10 years from now? I know the answer is never, but 20 years from now is closer to never than 5 years is, and it's certainly closer than 1 year. However, this creates problems too, because if we use accelerated depreciation and take a lot of write-offs this year and next year, what does that do to our profits? It knocks them down, and what's that do to your bonus as a manager? Well, I think it should be clear that we don't want to tell our shareholders that we're using accelerated depreciation. We only want to tell the tax collector. So I have an idea. Let's keep two sets of books. Let's tell the tax collector that we use accelerated depreciation, and that's why we're not reporting much earnings in these early years. And let's tell our shareholders that we use straight-line depreciation. That's why we can report fantastic earnings this year, and therefore are entitled to the bonus that we really think we're worth. And most organizations do things of this sort. How do you know they're doing it? Well, the first paragraph of notes, which of course few people ever read in the accounting statement, right behind all these financial statements, tells you what their financial reporting policies are. And generally they'll tell you what they use for financial purposes and what they use for tax purposes. The other giveaway, again, is to go over to the other side of the balance sheet. And remember, we're getting ahead of ourselves now. We'll talk about that in the next session. And see if there's a deferred tax item. Because you see, what we've done by accelerating depreciation is to put off taxes now at the expense of increasing them later. We have deferred taxes. And when you see a deferred tax item on the books, it means that management has been clever enough to keep at least two sets of books to boost their bonuses and make you shareholders happy, and to decrease our present tax bill and make Ben Franklin happy. Plant and equipment has some other problems that are a little bit beyond the scope of this discussion, but I think you can see that we have to worry about whether the plant is economically scaled. That is, whether it's competitive. Somebody else may have built a plant that's bigger and more efficient than ours, and so it may be that we're going to have to change our estimate of the useful life of the plant. Incidentally, accountants will let us do that. Anything that decreases the value of an asset, they won't argue about. They're willing to write down an asset, they're just not willing to write it up. And so we should really redefine the way accountants value assets. They value them at historic cost or market, whichever is less. Never more, but they're perfectly willing to take it down in value. So if you want to write off some plant and equipment, they'll permit you to do that. But you can't suddenly discover it's worth more and write it up. Now, the firm has other assets, too. In fact, I labeled them in the XYZ balance sheet, other fixed assets. These include a lot of things. They include intellectual property like patents and copyrights. They include investments in other businesses. We may own shares in IBM as an additional investment, a long-term investment. And because it's a long-term investment, we label it a fixed asset. If the same investment were made in IBM shares in the hopes of making a quick profit, that is, just put some money to work for a short time, we call it a current asset because we plan to convert it back to cash in a year. So the same asset could either be current or fixed, depending on what our intentions were in making the investment. Intellectual property also has a limited life. Patents typically have a 17-year life. Copyrights are usually the life of the author plus 50 years at this point. That sounds like a long time, but you see, if we buy a copyright from someone else that already has some aging on it, it may not have that many years left to run. And so we have to write off the historical cost of that asset to us over the expected life of the asset. So if we buy a copyright that's already been around for 46 years and we figure it only has 4 more years to go, but we pay $1 million for it, then we're going to have to write off, we call it amortization, $250,000 worth of that copyright every year for the next 4 years, so that it's down to its true value of 0 at the end of year 4. That's being conservative. One might even argue that we should accelerate the amortization because, after all, the book might go out of print or become unpopular. And, of course, the advantage of that is we can tell the tax collector we're writing it off quicker and therefore we should pay less taxes in these early years. When we get to the income statement, we'll talk about all sorts of ways that we can put it to the tax collector. Well, then, assets such as copyrights and patents have limited life, and they indeed have to be written off during the life of the asset. Now, we've talked about a lot of assets now. We've talked about current assets and we've talked about fixed assets. We also have to worry about what the appropriate mix of assets are. I think you can see that if we own fixed assets, we have a lot less flexibility with what we can do with them than if we own current assets. So a lot of firms try to avoid owning fixed assets. Well, how can we do that? Well, one possibility is don't make anything. Then we don't need any plant and equipment. But if we don't make anything, how are we going to have anything to sell? Well, how about if we buy it from somebody else and let them own the plant and equipment? You see, effectively then, the only assets we would have would be current assets. We'd have inventories, the things we bought from that supplier. We'd have receivables if we finance the sales to our customers. And we'd have cash, but we'd have no plant and equipment. Now, of course, built into the price that that supplier is selling us the product for is his depreciation of plant and equipment. But at least we don't have that investment. That's particularly attractive to new young companies that don't want to make a big investment, especially if they're not sure their great new product is going to work anyway. So we'll subcontract the manufacturer. Now, remember that I told you the appropriate answer to all questions is that it depends. Most of the things we were talking about have indeed trade-offs built into them. Let's go back to the receivables item again for just a moment. How do we know how many days of receivables we should have on the books? Well, it reflects our policy with regard to credit to our customers. How long should we give them to pay us? Well, there are a couple of reasonably good answers to that. I think they should pay us as soon as they turn our product into money, because if it's money, they could invest it and earn interest. And if they gave it to us, we could invest it and earn interest. So if we knew how long it took for the customer to take our product and convert it into cash, that would be a reasonable limit to how long we should extend credit to them. Well, how are we going to figure that out? Well, if we could get hold of his balance sheet and income statement, we could calculate the number of days of receivables he has on the books, by the formula we developed a minute ago. We could calculate the number of days of inventory he has on the books, again using the same formula we used for XYZ. And the sum of those two, the days of inventory plus the days of receivables, indeed is the amount of time it takes him to take our product, move it through inventory, maybe he even does something to it along the way, work in process, sell it, and then collect the receivable. We call that his operating cycle. In fact, we have an operating cycle too. XYZ's operating cycle is 72 days, 36 days of inventory plus 36 days of receivables. Our customer may have a much shorter operating cycle. For example, if we were selling beef patties to McDonald's, that's a sell it or smell it product. It doesn't lie in inventory for very long. And when they sell it for cash. So it doesn't take McDonald's very long to turn a hamburger patty into money. And so even though they're a very good customer, we would expect prompt payment from a McDonald's. And if we were selling to people like McDonald's, we should have relatively few days of receivables on the books. On the other hand, let's go back to Macy's. We produce women's garments and we're going to sell them to department stores. We know that the only way you can sell a garment is to have it on the rack at Macy's. And so really the answer to our inventory problem is to take all of our finished goods and ship them out to Macy's and stores like that as soon as possible to get them on the racks at the beginning of the season. If they stock out, the dress will never get sold because most people want to buy their clothes early in the season while they're still in style. Well, that means, though, that Macy's is going to have to carry a lot of days of inventory because at the beginning of the season, they've got a whole season's worth of dresses on the rack. Further, when Macy's sells them to you, they generally let you use a credit card. Very typically a Macy's credit card if they can convince you to buy or to get one. And we can even figure out how long they give you to pay them. They bill you once a month, and then they give you 30 days to pay after the bill arrives. Well, if you think about it, if somebody bills you once a month and gives you 30 days to pay, they should have 45 days of receivables in the books. You see why? If you bought the thing at the beginning of the month, it would be 30 days until they bill you, and then 30 days till you pay. That would mean it would be 60 days of receivables. But of course, if you were silly enough to buy the day before the billing cycle ended, you'd be billed the day after you purchased it and only get 30 days to pay, so you'd only have 30 days of receivables on the books. On average, then, people buy on the 15th day of the month, and it's 15 days until the bill goes out, plus 30 days to collect. And so a Macy's ought to have about 45 days of receivables on the books. Well, if you add 45 days of receivables to up to 90 days of inventory, a whole season's worth, that means it's taking Macy's 135 days to turn our dress into money. We're clearly going to have to offer Macy's a lot of credit That is, if we sell women's dresses, we're going to have a lot of days of receivables on the books, right?
Now, hopefully you guys can really catch what the presenter is putting down. A lot of individuals who are unfamiliar with the accounting principles, they slip into a position of not really understanding how ARs, APs work. And in today's class, I'm going to kind of touch on a continuation from yesterday. We got a major announcement with the USDA. I just need somebody to send me a thumbs up. Press 94 on the keypad. Let them know that my audio is coming in loud and clear and that you can hear me. What the presenter is basically speaking of is the ability to understand that the days that it takes to collect a date or days it takes to collect a debt becomes an extension on credit. And you live in a world where people who go to school, public school systems, believe that banks lend money, and banks don't lend money. Banks lend credit. And because it's an accounting cycle. And we're going to get into this whole aspect of what we think is happening versus what actually is happening. But what I'm going to do in this aspect of it is I'm going to share something with you. And this is coming directly from my lending platform. Yes, Apex Capital has its very own lending platform. We use Go Capital and NAC to, quote unquote, do a certain level of funding when it comes to M3 assets. But Apex Capital over the last 3 years has developed its very own platform. And what I'm going to share with you today is some of the underwriting software and how it's being used from an accounting perspective. So what I want you to do is just bear with me, because I don't know if you're going to be able to hear what I'm about to show you. Hopefully you can. Let me see if I can. I'm going to share this, see if it'll work here. All right, so I'm going to share the entire screen. All right, so everybody's seeing my entire screen now. So if you're seeing my entire screen, I'll see if I can go in my admin right quick. Apex Capital admin is what I'm looking for. Apex admin. Maybe it doesn't show right here. Let's see if I can. Let me back up. I think I know I can do it. I think I can bring up my history here, and I should be able to go to it because it was just up earlier. Let's see. Did I have it? Let's go back to previous day history. There we go. We're going to go to history and recently closed tabs, search history. Let's see. Not going to be able to go. Apex Capital. There we go, admin. Now I go to my admin. All right. And we use a automated software called Loan Disc. And I'm going to see if you guys can actually be able to see my screen. All right, and if you can see my screen, it's the accounting component that I want to show you here. Let's see. First off, let me just see if it'll let me cycle through. This will be where we got submissions for those that are scheduling their audits. I'm going to go here, see what comes up. See if we got any submissions. Okay, I see we got a Demetrius Jermaine. We got Mr. Hunter. Okay. All right, let's go back out of here. All right, got loans, borrowers. I want to go to show you how this thing kind of works from a whole different algorithm here. So let's see. All right, we're in the home branch. Let's go to see if this will show. I'm not sure if you're going to be able to hear this. This is the accounting. I think I may be able to bring it up in a separate, letting it populate. Trying to see if it's going to, it might give me a syntax error because it is being shared. This is proprietary information. All right, it's coming up. Not sure if we're going to be able to get audio out of this thing, though. Might not even be able to get a visual out of it. Yeah, I think it's not liking the share proponent. Okay, that's the borrower information. All right. Now, this right here, let's see. Yes, that's the accounting. If I can bring up the actual tab, I'll be able to actually start the player. All right, here we go. Now, I want to go to here because in this dialog, I'll be able to bring the player up. And I'm going to stop the share. Let's see if it'll let me reshare this. Let's see. All right, let's go here. Stop the share. Stop it. Okay. Now let's reshare and see if it'll let us bring it in this way. Viewer, web browser, entire. Okay. We'll try it. We'll see what happens.
Hi, welcome to Loan Desk. In this video, I will be showing you how to use the new accounting.
So I thought it's not giving us any audio.
Feature that we have just released. So the first step is that you go to admin, top menu, and then go to accounting and settings. And there you need to select whether you are doing accrual accounting or cash accounting. Now with accrual accounting, we basically count the income that you have added into the system, but not necessarily being
Yeah, it's not going to let you hear it.
click add bank account.
Yeah, you're not going to be able to hear it.
Your codes will be automatically generated. I would suggest you leave this.
Yep, you're not going to be able to hear it. That's what I thought. Let's go here. Nope, you're not going to be able to hear it. So let me kind of go into a different direction. I've actually uploaded this video onto the actual Bitrix space. So for those of you that can't hear it, you will be able to hear it when you go inside of the actual portal and watch the video. Basically, what this explains is the methodology of how you book these potential loans. If you set a parameter for M3 assets and then you allow it to be considered generally accepted accounting principle, then what it will do inside of this underwriting software is it'll create the petitions, it'll create the chart of accounts, and it will allow UCCs to serve as the predicating document. Unfortunately, I can't show that to you in this particular space for proprietary reasons. But if you have access to our Bitrix space, you definitely will be able to have access to that, to be able to see that. Quote unquote, a lot of individuals have to keep in mind that there are various different platforms for the rendering of loans, because they're all based upon what we will call standardized debt obligations. And they use a standardized debt application to do so. A lot of folks don't understand the parameters that govern those type of proponents. Like, for example, it says understanding the new accounting feature that they offer in LoanDisc. In this article, we will explore the new accounting features released by LoanDisc and learn how to use it effectively for managing financial transactions within the platform. The accounting feature offers two accounting methods, the accrual accounting and cash accounting. We will dive into the differences between these methods and how to select the appropriate option for your needs. Additionally, we will guide you through the process of adding bank accounts and loans, as well as understanding the profit and loss reports. Basically, it breaks down the accrual and accounting, accrual versus accounting. The accrual accounting and cash accounting are two distinctive methods of recording financial transactions, and each has its implications on how income and expenses are recognized. Let's understand the key differences. Under accrual, with the accrual accounting, income is recorded when it is earned, irrespective of whether it has been received yet. For example, if a loan installment is due from a borrower, it will be considered as income in the profit and loss statement, even if the payment has not been received. In the cash accounting method, in contrast, cash accounting only recognizes income when it is received, and expenses are recorded when they are paid. For loans, this means that only actual payments made by borrowers will show as income in the profit and loss statement. Now, for those of you who have been into our accounting courses and understand the differences or the rules, what we call credits and debits, this is it's worth its weight in gold when you're understanding how these parameters really work. For your new people, I'm going to suggest if you already don't have one, you need to invest into an accounting manual. If you already don't have one, which I have them available, and you want to, I always tell new students to read at least the first 30 pages of that manual. That manual is about 900 pages, and if you at least read the first 5 pages, it'll give you a pretty good synopsis of how credits and debits work, especially now for you guys that are going to be working these loans. In other words, the software itself can be altered, it can be critiqued, it can be used to determine net asset value. It can be used to create discount cash flow models, profit and loss statements, income statements, all off of what you implement on a UCC. Couple that UCC with an actual 1003, which is a standardized form for real estate purchases. Now you got some synergy. And so unfortunately, I can show it to you, but I just can't. You won't get any audio. And I don't want to just go through my whole layout of the software. I guess I could do something like this. Okay. What can I show them? I can show them. Oh, I can show the categories. All right. Because some of you guys will be onboarded. Like for you guys that are actually in the Banking in the Box platform, you will have access to this underwriting software. If you're not in the Banking in the Box, then you need to get with someone who is, because they'll be the ones that'll be using this software. I can show them this. So let me try this right here. You guys should be seeing my whole screen. I don't know if you are. I'm gonna stop it and repetition it. So if you can't see it, you should be able to see it now. This layout in the admin lets you, of course, you got your account settings, you manage staff. This is the borrower's information, so we can manage the borrower settings, the statements and schedules. We can also implement the loan products that we want to use. Um, this nifty feature here does all the e-signatures. This right here is awesome. There's an investor portal. Now, what happens is I have borrowers and I also have investors in this platform. And what an investor does is when a loan is written and it has insurance and it can be reinsured, they inquire about the loan and they literally purchase the loan. So these investors buy these packages. So for those of you that are loan officers, you're never sitting on non-performing paper. And also for those of you that are doing noting and minuting, you get very creative in the aspect of how you can utilize that. But this is our back office, and this is various different things that you can utilize. Now, again, I can't go into all of this for proprietary reasons. I'm just showing you that we do have a formidable platform to monetize M3 assets into a 2-in-1. And I encourage all those that have come in as of lately as notaries to go ahead and onboard, become a broker with Go Capital and North Avenue Capital because of the things you were able to do in this particular space. Now, with that being said, I'll stop the share and I will talk about the format, the platform. How does M3 Assets move through the accounting cycle? All loans are managed by some sort of automated underwriting software like what you're looking at here, which I've shown you. But there's a particular form. And there's a form I don't talk about a lot in the interim because I typically try to see where everybody is at. And then when we get into strategic questions about how to move value from one set of books to the other, we get into the various different forms. The form I'm about to show you now will probably change a lot of you guys' total outlook on how conveyances work. Again, I'm not here to blow your mind. I'm just simply here to open your mind. Hopefully, this will prompt certain questions. Let's share the screen again. And let's now go. Everyone should be able to see on the screen a form 1098F. That's 1098F. Can everybody see that? Somebody give me a thumbs up. Let me know that when you're looking at the screen, you can. Okay, so we got somebody say they can see it. Beautiful. All right. How many of you guys ever seen a 1098F? And I'm going to go ahead and unmute everyone. I want you to mute yourself, and then if you want to answer a question, you can unmute yourself and answer. I'm going to go ahead, and I'm going to attempt to unmute everyone. Hopefully I don't get a whole lot of background noise. Go ahead and mute yourself if you hadn't already done so, and I'll allow yourself to unmute yourself to answer. How many of you guys actually have seen a 1098F before?
I have not.
Okay. When you look at this form, notice right on this side where it says 0303, we're going to call this the debit side of the ledger. Everything that's in this middle line right here under the word corrected, credit side. So any information that you put on this side of this ledger is for debit purposes. Everything that you put on this side is for credit purposes. Does that make sense to everybody?
Absolutely.
All right. Now, as you look at this form, 1098F, which is labeled fines, penalties, and other amounts. You look at number 1 where it says total amount required to be paid. Number 2, amount to be paid for violation or potential violations. Number 3, restitution, remediation amount. Number 14, compliance amount. What does number 6 say?
Court or entity.
What does number 5 say?
Date of order, agreement.
What does number 7 say?
Case number.
What does number 8 say?
Case name or names of parties to suit, order, or agreement.
Based upon these line items, what do you think you can use this form for?
Support.
Well, obviously
Yeah.
obviously to pay any court costs.
What you say?
Yeah.
Right. All right.
You can file this. You can file this ahead of time so that, because, like you said, we really should never have to be in court if we just file the proper paperwork.
As notaries, this becomes part of your toolbox.
Mm-hmm.
This is a major tool, but this is not to go outside of the scope of knowledgeable fiduciaries. Reason why is because this form that I'm showing you online, it shows you this form, but when you actually order this form, it's probably going to come in a statement of 3. Just like, how many of you guys actually have printed off a 1099-C online and actually ordered the forms from the IRS? Has anyone ever done that?
I've ordered the forms from the IRS.
And have you compared it? Have you compared it to the forms that you get online?
You can't scan the ones offline.
You can't. Yeah.
Right. But the biggest difference is when you look at the form, especially the 1099-C, there's 3 1099-Cs on one form.
Mm-hmm. Oh.
Right. So
You're not talking about the carbon copy, are you? You saying
no, the front page is 3 different debts.
Mm-hmm.
So when you submit your submission, you're not submitting one debt to the IRS. You're submitting minimally 3. Now, as a notary, you can use the form online to chronologically order your noting and minuting because they can be 1 page at a time. But when you make your submissions, 3 debts per filing. I'm teaching this now. I didn't think I had to, but I think I do because I got into a very interesting conversation with someone who was like, I got my 1099-Cs, and we got into this conversation of, you do know that there's supposed to be 2 more debts on this form. This is why you're not supposed to use the forms online. Order the ones that, we'll go here. The reason why you get to use the forms online is because you haven't received the forms that you've ordered yet. So you have to understand that when you actually get the forms, because when you do, you're going to have to go back and reconcile all those other forms you pulled offline. 1, they're not scannable. Now, if you are actually a member of the fire system, meaning that you got a CAF number and you have already enrolled in that system, then you can use that information because they're going to simply ask you to upload and convey that information electronically. What's another thing that if you got a 1099-C and never filed one that, well, I'll go here. Here's my question. If you receive a 1099-C, can you handwrite on the form? And it be accepted by the IRS?
I don't see why not.
You are allowed to handwrite on these forms as long as you're not submitting more than 250.
Yeah, if it's over 250, you have to do it electronically.
You got to be in the system, right? And of course, you got to have good penmanship. You know, you can't send them chicken scratch where they can't read it. That's gonna be a problem. But this 1098F, let's go back to that. From looking at these entries, this potentially is a form that can be used to move judgments, correct?
Yeah, that's what I was going to say when it says entity and agreements,
Mm-hmm. Contracts.
contracts. That's what that,
Or a court order, or if you're doing arbitration, a judgment.
a judgment.
The type of court or entity, so it'll be arbitration, or if you're in the public, it'll be a public tribunal, quote unquote. Case number. I find it amusing that, for example, the way this system is set up, every time you make your credit card payment, you're supposed to be receiving a 1099-C to cancel the cancellation of debt. Anyone that you've given fiat to, they're supposed to return to you at the end of the year 1099-C. So if you don't get one from the individuals that supposedly you've been doing business with, is your books in balance or out of balance?
They're out of balance.
Out of
You need to make your own 1099-Cs.
Right. And that helps bring it in back into reconciliation. Now, I want you to understand that for those of you that have already gone online, have already gone to our website and made your submissions for your securitization audit, I'm showing you the mechanisms that's going to be used to substantiate your conveyances in hopes that with the submissions that you're making, you will understand who you are in the transaction and how they have a predestined mode of operations for conveyances. Remember, we split the settlement, the security settlement system into two parts, like ongoing and outgoing traffic, incoming and outgoing traffic. We're going to say everything going inside the CRIS is going to travel by way of DTC. Everything's going to come out of the CRIS is going to travel by way of DTCC. And there are bills of exchanges. There are rules like I'm really going to press you to associate. If I'm dealing with putting things in the CRIS, I should have a cycle of what that looks like. So I know I'm not guessing and, and again, I love interacting with students when we're building in a certain capacity. The thing though that kind of slows me down is when I'm already on page 100 and I got to go back to page 1 because you have 100, but you still haven't done page 1. 1 is still kind of, I don't know what to put there. So I'll eventually get to it. And what happens, it gets buried in every other thing that you learn. For example, why do we as compliance officers prefer using an M3 conveyance over an M2 and M1 when it comes exclusively to these type of judgments?
Decreases liability.
Decreases liability.
And it doesn't create taxable implications.
Right. So by using M3 conveyances, the cost to convey is far less expensive. Like to move things to a 2 and a 1, somebody's going to have to pay for general liability insurance. Someone's going to have to insure the transaction as is and reinsure it. It has to have 3 types of insurance just to touch this stuff. Now, because we're so used to not being fully responsible, isn't this why the bank has FDIC insurance? We're thinking it's to protect us. It's to protect them from you. Up to $250,000, in a conventional standpoint. Now, everybody that's in commerce that you're getting your commerce through and from, they're all bonded and insured. And nowhere in your engagement are you putting your policy number and indemnities out there. So they're supposed to make you liable by telling the IRS that, yeah, they gave us fiat, but it really was a gift. They gifted that to us. And when you give someone a gift, what did the person who receives a gift, what do? They enjoy it, right? So they enjoy the gift. So if you don't have any insurance, you're not enjoying the gift. You're liable for the gift. And it's almost like going to it's like, let's say you're a store. It's like I come into your store, I go grab the food off the shelf, I walk straight back to my car, take the food home, prepare it, eat it, and have, a bowel movement or two. Then I come back and say, you know what, that meat was crap. I want a credit on something else now. Now, if you're running that store and you allow those type of conveyances, you're probably not going to be in business very long. So every time we don't take full responsibility for our actions in commerce, that's how reckless we become. And so different trusts, different fiduciaries take extreme measures to what? To protect their storehouse, to protect their wheelhouse, to protect the integrity of their estate. Almost to a point where they'll say, okay, well, if we're going to do business with you, then fill out this application. And they take the data that's on that application, and that's what they lend to you. You're paying back your own commercial energy that you created. And you're going to be liable for it. And if you can't, then we're going to take some more of your stuff and reconvey it to somebody else. Pretty soon, if I'm in that type of business of conveying and reconveying, then it's just a matter of what? Checks and balances, accounting. You can't have creditors without any debtors. So some individuals are better debtors than others. So having great credit simply means you're a good debtor. The paper is insurable. How much does it cost to get general liability insurance on a brand new LLC? Does anybody know?
Under $100.
Under $300 to buy $1 million of general liability insurance. In the trucking industry, how much does it cost to insure a tractor and trailer that's probably over the 2021 range? What does insurance run you these days?
More than 300.
More than 300, but it's because you got a commercial license to haul freight, right?
Right.
So the business that receives the freight minimally has to be insured by $1 million, and the individual that brings the freight that's going to be used by the consumers, they have to have $1 million general liability policy. So wouldn't it make sense that the person who's going to actually buy the stuff off the shelf and may hurt themselves or my kid or the neighbors, they need to be insured too?
Everybody else is.
Like everybody else is insured if you get hurt and you come after them. That's what that insurance is for. But what about having insurance in case you bought something that potentially causes you harm commercially? Doesn't that make sense? Like if you're in a contract and everybody in the contract is insured, can't you create an arbitration clause that if things go left, we're going to make a claim on each other's insurance to make the other person whole? Doesn't that make sense?
A remedy.
What if you negotiated the contracts up front that way?
That decreased liability.
What if out of 100 vendors, all of your vendors rely upon insurance claims for conveyances? And I'm really trying to throw you something here, and I'm trying to provoke you to think. They agree that every 45 days they're going to recoup every dollar that they spend. They only got to focus on recouping 30% through their collection practices, and the other 70 insurance will recoup. So that means if they issue $100 of goods, as long as they can successfully get 30 of those dollars in, insurance will make up the 70% that they'll lose in the sauce. So they know they know they do that every 45 days. So in 45 days, if they've gotten 30% of what's out there back into, through collections, they file a claim to collect the other 70. Now, what happens when the clients finally pay them, even though they've already made a claim and got the 70? What happens to that capital?
Yeah.
Well, if you're smart, wouldn't you put that back on your book in a form of appreciation? Or would you invest that 70% into another revenue stream? What if you're a business that can actually monetize leases? So if you leasing the building that you're in, the house that you're in, the cars that you drive, the equipment that you're using, the machines that you need for manufacturing, everything that's a lease, you're able to leverage that. What if those leases could actually become income?
That's security.
Are you understanding the potential and possibilities?
Yes, yes, yes.
Yes, indeed.
All right, so with that being said, knowing how to use this 1098F becomes even more interesting, because in number 5, they're not just talking about court orders that we do in arbitration. They're talking about contracts. Couldn't you actually look at this form as a form of insurance? Couldn't you strategically look at a 1098F as a form of insurance?
Because you could
Anyone want to?
substantiate before you act on this
There you
1098.
go.
Yeah.
Exactly. And with that being said, that gives you all of the green light to go as fast or as slow as you want. Now, what I'm going to do is I'm going to put everybody back on mute just for a second, because I want to share something with you. Keep listening, because if you listen long enough, you definitely will learn something. Now, keep in mind what we discussed with the 1098F. I'm kind of jumping the gun. Some of you guys that are in advanced classes will get this, because we brought this up before I had to end the class a little early yesterday. So I'm going to bring it back up and continue in that same energy. Pay attention. Remember, all I'm offering is the truth, nothing more, nothing less. And if anything motivates you to take action, but this action may require you to have some sort of legal practitioner, we ask that you seek those that profess to give legal advice, because here in WTDTA Radio, Spellbound Media Entertainment, Apex Capital, and all of our affiliates, all we profess to do is give you educational information only. So take heed. But hopefully this will kind of bring some closure for you guys. Pay attention.
Hello and welcome to Wall Street Training's LBO Leveraged Buyout Overview course. Please note that these materials are copyrighted and may not be disseminated or reproduced for any reason without express written consent from Wall Street Training. Wall Street Training provides financial modeling, valuation modeling, mergers and acquisitions, merger and leveraged buyout modeling, training to corporations, as well as through public open enrollment seminars and self-study video-based learning. My name is Hamilton Lin, President and Founder of Wall Street Training, and I will be your instructor throughout this course. My background is primarily in investment banking and mergers and acquisitions, having worked at Goldman Sachs' investment banking research, Bank of America Securities' mergers and acquisitions group, and several other smaller boutique investment banks, again all focused on mergers and acquisitions. Personally, I have executed a fair amount of LBO transactions ranging from as small as $10 million to over $6 billion. I am a CFA charter holder as well as a CFA instructor. The goals of this course is to provide a basic overview and introduction to leveraged buyouts, including a discussion and rationale of going private, the ideal LBO candidate, as well as drivers of value. We will also discuss the following items, including a description, importance, and implications of various items such as valuation, debt capacity, scenario analysis, sources and uses of funds, role of equity, and capital structure. We will also spend a little bit of time focusing on purchase accounting versus recap accounting, goodwill treatment, and other issues. You will be able to gain a fundamental knowledge required to understand leveraged transactions after you are done with this basic overview. To hone the concepts learned on this module, please be sure to follow up this course with our quick and dirty basic leveraged buyout modeling and, of course, our complex leveraged buyout modeling course. This does currently assume that you have a basic understanding of accounting, fundamental concepts in finance and valuation, and we highly recommend prerequisites to this course include our accounting and financial statements integration, our finance 101, and our corporate valuation courses at a bare minimum. Let's now turn our attention to the very first slide. What is a leveraged buyout? A leveraged buyout can be thought of through the following analogy. Leveraged buyout is simply using debt to buy something out, hence the word leverage and buyout. Now, you can akin this to the following analogy. Let's say you're buying a real estate property. Let's say you're buying a real estate property and the current owners of this property, let's say, currently have an 80% equity stake and they have yet to pay off the remaining 20% of the mortgage. You come in here and you borrow a massive amount of debt and you put down, let's say, anywhere between 10 to 20% to purchase this property, and you put down and you borrow anywhere between 80 to 90%. This is the leveraged buyout portion. Then you will use the internally generated cash flows. Key is the internally generated cash flows to pay down the debt and build equity. Build equity such that by the time you're done, your equity stake, not that this is drawn to scale, but pretend that there is no appreciation in the actual asset, but you will be able to build your equity up to the point using the internal cash flows generated to pay down the debt. And this allows you to now own a greater percentage of the company upon an exit or upon a sale. This is considered typically a financial...
Now, hopefully, you guys might have didn't catch what Han was just saying, so I'm just going to narrate just briefly for those of you that will be listening to this a little bit later on, and you'll get the aha moment. He just gave you technically how mortgages operate by using the leverage buyout analysis, leveraging debt to buy something. In other words, you'll hear terms like loans being assumable. FHA loans are assumable. Some conventional loans may be, assumable. Some USDA loans may be assumable. As a loan officer, when you find out that there's an existing loan on a particular property, you may want to inquire whether or not that loan is assumable. Because if it's assumable, you can utilize an LBO proponent to acquire it. Keep listening, because if you listen long enough, you learn something.
Transaction and usually sets the floor or the minimum valuation. Why is that? Because if a strategic buyer comes in theory, this is in theory now, they can also do the same thing and extract additional value if they're able to actually also provide economies of scale or cost savings or whatnot. Typically now, who is the private equity firm that is coming in? This is the person who is actually supplying the core capital, the equity base. Now, what is private equity? Think about private equities opposite the public equity market. What's the public equity market? That's simply the capital markets, the stock exchange, etc. So therefore, the private equity markets are basically sources of capital, sources of equity that are from private sources as opposed to the public, general John Doe investor, etc. Now, let's flip to the next slide. Leveraged buyouts basically provide a current market view of the range of hypothetical purchase prices by a third-party financial buyer. This is typically contingent upon several items. You must have an acceptable capital structure. You must have the right interest rate and return requirements for both the equity and the debt. We'll talk more about this a little bit. And also refinancing terms and whatnot. Typically speaking, and of course these targets will continuously change, especially as you meet different market trends in the current LBO cycle. But typically speaking, private equity firms like to generate at least a return of 25 to 30%. Here's a list of reasons why you might want to go private. Typically, LBO requires the buy-in of the management team. Hence, by the way, LBOs are sometimes considered MBOs for management buyouts because you absolutely need the management team to go there and run the company or bring in your own management team because you do not want to be running a portfolio company because you have, let's say, several of these portfolio companies. You're not going to be able to allocate the time that's required to run the day-to-day operations. Hence,
if you ain't figured it out, this training is preparing you to become managed buyout specialists. Leverage buyouts lay upon the tip of the tongue of the private sector. And your ability to master asymmetric information lets you come in and utilize a managed buyout because it's a team. A team of compliance officers, civil law notaries who utilize arbitrage and arbitration and utilize M3 conveyances puts you into that formula. So when you're talking to realtors and recruiting those to participate in that structure, you're strategically running a managed buyout firm. You're utilizing managed buyouts. In the industry, it's called a leveraged buyout. And you're going to need a team of individuals who understand conveyances. This is why we tether ourselves to a very simple format. When you acquire real estate, you want to make sure that real estate can be acquired in a position that gives you the most control and protection. We suggest doing what we call assignment, which the assignment means that the seller agrees to sell the property while being corralled, placed into an agreement that makes them a beneficiary of the trust. In other words, the trust that's buying the property requires the seller to become a beneficiary of the trust. And there's going to be a trust that's going to be created specifically for that real estate acquisition. That's one requirement. The second requirement is they agree to receive the proceeds in a format that's acceptable under generally accepted accounting principles. And because it's going to be accepted under generally accepted accounting principles, it should be done through what we call a K1 conveyance. Now, a K1 conveyance can be tied to an M3, which doesn't create a taxable jurisdiction. This, in my opinion, these private closings can be done very quickly with a managed team, but a team of professionals who understand how M3 conveyances work. Keep listening because if you listen long enough, you definitely will learn something.
Reason why the management team is absolutely critical. Let's go into several reasons why LBOs are done. First of all, the public markets are not properly rewarding a company's true or intrinsic value. In this case, for instance, during the dot-com internet bubble, the quality, quote-unquote, old economy stocks were ignored and punished unnecessarily. In that case there, you might see that a lot of these firms realizing there's a lot of internally generated cash flows, the valuations are depressed. We'll talk about the ideal LBO candidate in a second, and therefore the private equities might want to come in. Lack of a strategic fit with the parent company. A company may want to divest their non-core assets. Well, there's a perfect opportunity to do a leverage buyout there and take it in-house within the management team. Similarly, there might be a lack of attention from the headquarters of the parent company, and therefore there's a little bit of disgruntledness, and that subsidiary might decide to say, listen, I want to get myself out and I can grow if I have the right resources. Hence, the parent company might decide to say, nope, don't want that, or it's not priority right now. Regulatory issues, antitrust dynamics. Many times you have consolidated entities in an M&A who might be forced to divest a part of the business so that they will not get too big, all due to antitrust dynamics. For smaller middle market companies, perhaps, or private.
Let's talk about the antitrust dynamics. Antitrust dynamics fall into a couple of spaces. One space will be, for example, under antitrust dynamics, if you are operating under non-disclosure agreements and operating agreements, your chances of tripping into antitrust dynamics are slim to none. You don't have to disclose certain things that will basically put you on the tax block. Not understanding the antitrust dynamics, you are going to develop regulatory issues. One of the biggest things we do in the accounting space, in my space, especially of being a member of FASB, is we're always having to redefine the line for those that wrote the line. Like, there's a new standard that we're going to talk about today. A new word is called de-aggregation. You have aggregation, you have aggression. So they have introduced a term called de-aggression. And during our meeting this morning, we were talking about the fact that certain institutions who have been targeted aggressively for liability purposes have a fail-safe within the FASB ruling where they can de-escalate that by using de-aggression. I'll give you all the details as we go forward. But understanding the antitrust dynamics are essential in protecting one's asset when performing or dealing with leverage buyout opportunity. Keep listening, because if you listen enough, you'll definitely learn something.
Privately held companies. A significant shareholder or owner might decide to retire, and this way, this will pave the way for existing management team to potentially own the business through a leveraged buyout. And let's now take a look at the ideal LBO candidate. First of all, as we mentioned already, you must have an experienced management team. A strong CEO and CFO are absolutely critical. Why? Because the CEO is supposedly supposed to provide the strategy and the strategic direction, whereas the CFO is the numbers person. And therefore, they are the ones who are probably among the most critical, as well as, of course, making sure that the company is intact. So COO, sales, etc., marketing, all obviously very critical as well. Financial profile, this is pretty important. The company must have an ability to generate a steady stream of cash flows. If the cash flows are not there, nobody's going to buy the company. Why not? The private equity firms need to make sure that there's steady cash flow to pay off the debt so that their equity stake does not go to nil. The banks, the ones providing the leverage and the debt, they want to make sure that they can get repaid, so there must, once again, be a steady stream of cash flows. This is probably one of the most important attributes of an ideal LBO candidate. Why? Because these cash flows must fund the operations and continue to pay down the debt. In conjunction with that, there must be low debt balances, or there ideally would be a low debt balance. Why? Because therefore, additional leverage can be employed on this LBO. If you're already fully tapped out, and you can't do much additional with your capital structure, that's going to be a potential problem here, because if you already can't borrow additional funds to fund this leverage buyout by definition, you might have a little bit of a problem there. High cash balances are ideal as well. Why is high cash balance? Because that, first of all, offsets the debt, but also you can use the cash clearly to actually pay for the actual leverage buyout acquisition. In combination with all of these, you must also have a relatively cheap valuation. Why must you have a relatively cheap valuation? This way, if the public markets are undervaluing this particular entity and this firm, you can now go in there and you don't have to pay as much than if it were already fairly or overvalued. And therefore, from the perspective of the financial profile, it is very important to make sure you have all four of these components as much as you can. Also, there must be sufficient assets for collateral. Why? Because
let me discuss a particular strategy for valuation that may help you in determining a overvalued firm versus an undervalued firm. Now, I'm going to change the names to protect the innocent. We're just having a general conversation, so I will not go into the details of this particular case. We'll say Company A has an audited financial of $2 million. The company is spending 39% of disposable income on expenses. The company is in its 5th year of their 5-year financial forecast. This is a publicly traded entity. So this entity that was publicly traded 5 years into their financial forecast, spending over 36% of their disposable income on expenses, was given a red pill, blue pill moment. One pill, you can see how deep the rabbit hole goes. The other pill, you can take it and believe whatever you want to believe. So this company decided that it would take the pill that it will see how far the rabbit hole goes. Upon taking the pill to see how far the rabbit hole went, this $2 million valuation found that this $2 million valuation actually was greatly undervalued. And when I say greatly undervalued, see, there was major hurdles that this company had to go through to get to the point of where they were. But no one in their management or accounting team was able to substantiate, recapture, and recover those accounts that were used to get to a formidable position. Fast forward, half of the first 5 years was spent getting the company to a break-even position. The second half of the 5 years was now realizing the glass is now half empty if they can come up with a new management strategy. See, the previous CEO and CEO only had enough experience to get them through the break-even period. They now needed a formidable management team that could take these new funding opportunities to the next level. So in order for this corporation to preserve the integrity of the estate, it was asked to participate in a leveraged buyout that would be assisted by a managed buyout proponent. They were asked to bring forth the CEO and CFO who could at least retain a $7.5 to $12 million key man policy. That $7.5, $10 million key man policy, their expertise in the marketplace was more than enough to make those shareholders comfortable in sinking more capital into the present share of those companies and corporations. Needless to say, once management took over, they were able to offer a buyback strategy for the shareholders. They agreed to part capital into this company for at least the first 3 quarters of that particular year. And like overnight, this $2 million company became a $50 million company. Now, I saved the names to protect the innocent. These things happen all the time when you understand the rules of accounting. These things always happen outside of those that understand the rules of accounting. So failure to understand rules create these opportunities, and knowing these rules create opportunities. In other words, the general population believes that somehow money travels through wires, through trapeze and birds and all kinds of apparatuses. When money is simply being manipulated through accounting, it's ledgering. A debit becomes a credit becomes a debit. The end. Understand that what Han is breaking down, and again, he is giving you, and this is, I'm kind of skipping ahead because this is a very advanced presentation. I just simply wanted to kind of give you a focal point, an idea of what an LBO looks like from a mortgage standpoint, especially for a lot of you guys that are submitting loans. Like, we're actually, each individual who actually has a portfolio to go ahead and fill out the audit, the securitization audit form that's on our website, because that allows us to get you into a schedule for disbursement. Now, remember what I showed you in software, because we also have a whole panel of investors that are looking to utilize these M3 assets. But I don't want to lose anyone. I don't want to go too fast. Again, those of you that are in Banking in the Box, you will have access to the entire Wall Street training format. There are 21 classes that Han teaches, and we make those courses available because now that you got the tools, now that you got the tech, now that you understand your method of accounting, now it's just a matter of being able to immediately assess a company, whether it's valued properly or undervalued, and then go into retroactive mode through LBOs and hedging accounts. At this point, I may have some questions. Hopefully, I do. I'm going to go ahead and stop this portion of it and give everybody a chance to press 9-4 on your keypad if you have any questions pertaining to anything you've heard up until this point. Press 9-4 on your keypad if you got any questions, comments, or concerns over anything we just presented up until this point. Don't be shy. There's not a crazy question you can ask at this point, but I kind of need to know where everybody's at so I'll know exactly which way to position you. If there is no questions, then I will go directly into what the new accounting rule that was being used by FASB today, and then I'll give you the really good news on the USDA. I have a question. Let's see. Brother Mark, talk to me.
Yes, on this 1090F, I didn't get the amount that you can go up to discharge.
Well, there's no minimum. Let's just say there's no maximum. It has to be at least over $600.
Okay. All right. Thank you.
All right. Any other questions? Okay, I think we got another question. Mark, if you got another question, I think you can unmute yourself, big bro.
No, that was the only question so far.
Okay, good deal. All right. Okay, we got someone, last 4 digits, 2239. I think that's Brother Allen, isn't it? Can you hear me?
Yes, 1098 is the
Okay, go ahead and say that again. Go ahead, brother. Go ahead. Last 4 digits of your numbers, 2239. Go ahead.
Is it 1098 to report a transaction?
That you're going to use Form 1098F if it's in the space of a particular judgment, court order, or contract. that's not the only form to report payment. Like, let me kind of give you an elementary lesson in this. If you make a credit card payment, at the end of the year, the credit card company is supposed to send you a 1099-C. You understand me?
Yeah.
Okay. The form that I was showing you, the 1098-F, is a different type of form, dealing with a different type of asset class and or conveyance. But the cancellation of debt is supposed to be issued at the end of that accounting cycle.
Okay. So that has anything to do with the case that we are in now?
Well, the 1098-F will be used, and a K-1 will be used. Yes.
Okay.
The 1099-C will be a different form that you will actually go through and fill out. It's sort of like this. If I lay out, there's about 10 forms you're going to touch. To explain them would take another hour or so. But what I would like to do is just kind of walk you through this in conversation.
Okay.
If you have given money to an institution and you have not received what we call a 1099-C, and you'll tell me, well, Mr. Bay, I paid that debt. That debt is this. They've discharged it. They forgave it, blah, blah, blah. If you don't have a 1099-C, then your books are running wild. And if your books are running wild, you actually have actual credit that I can technically consider as unearned revenue that you can use. Like, if you were an S Corp and you said the same thing, I would go back 3 years and recoup all the capital that you spent over the last 3 years and then bring them forward so you can use it now. And the only thing that makes you different than the S Corp or C Corp is position, is insurances, is infrastructure, management. Now, if you acquired a trust and you had a pretty solid management team and you were able to insure your transaction before you received the capital and you can get it reinsured after you got the capital, then I would do the exact same thing that every other S Corp and C Corp does in that situation. We'll go back to go forward. We'll go back 3 years, 7 years, sometimes 10 years, and then bring that capital forward. Now I'm walking you through it in conversation. This is how commerce is supposed to go here in the States under generally accepted accounting principles. So when you don't rock by those rules, now these same rules go after you because the flow of commerce is utilize the flow of commerce, and capital will flow where it is rewarded. Capital will flee where it's being punished. Capital is being punished when accounting is not being done. Capital flows when accounting is being embraced.
Okay.
Does that make sense to you?
It makes sense.
Beautiful.
So if you keep a good ledger, then you'll be flowing in capital. But if you don't got one, then they after you.
Exactly. That's how the rules are set. So it's essential that, like the air you breathe, understanding the flow of capital. Like in every cycle, when you see institutions create legislation that restricts commerce, it's heaping up opportunities on the opposite side of it. Like, let's take, for example, what's happening in the Brits right now. You're familiar with Brits, right? What's happening?
Prince, yeah.
Right. All right. So all of these countries that have agreed to operate in commerce outside of the United States Federal Reserve note, they have created their own private exchange. And they have the blessing of the Bank of International Settlement. Now, of course, there's rumors of war because all wars are bankers' wars. See, the United States has gotten very comfortable with everybody dealing with the dollar. Now that everybody don't want to deal with the dollar, there's problems commercially. So any country that no longer agrees that United States GAAP is favorable to their country can return back to what? That 5,000-year-old standard. This ain't new. It's not new. These things happen in cycles. It's just that in our lifetime, we've been the witness. You know, if you're 50 years or older, we have been here in the United States off of the silver and gold standard for over 50 years. All we've known for 50 years is credit. And a lot of countries have already repatriated their gold and silver. Think about that for a second. Countries have repatriated their gold and silver. And we're all out here all willy-nilly with no insurance whatsoever in a lot of instances. I'm not speaking to nobody, and most of you guys that are in this class, you guys got gold and silver and a whole bunch of other stuff. I'm not talking to you. I'm saying just for general purposes, the majority of the individuals that's not in this class are only a paycheck away from being homeless. That's the reality. They have less than $500 in a savings account. So right now, if the earth and the moon and the universe shift, and they said in order for you to thrive, you got to put your hands on $10,000 in cash, and you need to buy X amount of silver in order for you to be able to leave your territory. If you can't do that, they don't have to bring a prison. You're already in prison. They'll call them 15-minute cities, and you're only going to be able to leave when you got a certain color in a day. This sounds like science fiction. I'm just simply telling you what Janet Yellen has already done. Remember, if you know what BRICS is about, Janet ain't new to this. Isn't that what she did in Europe before she came here? I mean, she's got bodies all behind her. Y'all do know that, right? I'm not talking foreign to anybody. You do know that Janet Yellen being in the position that she's in wasn't a great thing for individuals who were asleep behind the wheel. You ever heard the saying, it's like putting foxes in charge of the hen house? You keep wondering why the fox getting fat, and he keep telling you don't know what's happened to the chickens. But he gonna find out, and another chicken disappears. Like, if individuals are telling you don't worry about operating in trust, and they are operating in trust, but they tell you don't worry about that, that doesn't apply to you, and you just take their word for it, then, remember, consent, you can't claim an injury. And you can't say, well, I didn't know. You start sounding like Kanye. Well, being poor is a choice. You're choosing that. It's easy to be a victim. In the politics and accounting of things, when it comes to reparations, I honestly think a lot of our people are making the wrong argument. I'm not saying you're not going to get it. It's just that I'm at 50 years old, I'm hearing the wrong argument. I can't tell you I can't say what the argument is because that's really past the scary line. They're waiting on me to say that so they can cut my feed. but you should know what I mean. Like, everybody in this class should really know what the argument is. And they have a vested interest to not patronize what the real issue is.
So being a new student, there's a lot I got to catch up on.
Oh, yes. See, the correcting of the status and being able to send the court an M3 asset, this is the accounting function. This is the mechanics. This is the logistics. You're going to have to know why that is possible in order for you to stay on top of the management of those assets. Because there's a vested interest in that estate. Now, when I'm speaking to you about estate, I'm saying the state of, they got a claim on you as the estate, right? They got a claim on it.
Yeah.
And so they have a legitimate reason to pull out all stops, because on their paperwork, they have a claim on that estate. But in commerce, that claim can be fulfilled with lawful legal money. But you can't do it being black, Negroed, and colored.
So what makes they claim valid and not mine?
Say that again.
What would make their claim valid and not my claim?
Creditors are looking at not who shot John and who dope was it. Creditors are looking at who was damaged, who needs to be paid. So commercially, what they're saying is, if you are a citizen, government does not have to respect citizens. They respect private citizens, because a private citizen is going to come, first of all, with a certain level of value in commerce. And the only thing we can talk about is how that value is being conveyed. In this country, as bad as a lot of us, and I'm guilty of this too, talk about it, it's one of the only countries on the planet that if whatever you want to do, good, bad, or indifferent, you can get a license to do. So creditors will throw out the dope ain't mine, this, that, and the other. They're listening for, okay, well, the facts are on the moon. It ain't about what you say, it's about what you can prove. And you can't prove anything, because if you're going around making statements and saying stuff and you're not putting your bond on the record, notice these individuals, what gives them superiority in that scenario is that they're not deviating from the statements that they made, especially if those statements were bonded. I'm without going all the way into your case, they made statements that they forced you to be bonded on. That's why. So your only rebuttal is to lay your insurance on top, saying, hey, here's my coverage, make a claim, get paid. But you don't have to do this, that, and the other, because I'm giving you what you need to get paid. You don't have to hold my body in lieu. I'm freely giving you what you're asking for. I'm not arguing about the dope ain't mine and who shot John. You want to be paid, I'm here to render payment. But I can't render payment until the books make sense. I need to know what I'm paying.
And that's where arbitration come into the business.
There you go. That's where the arbitration comes in. The arbitration is a record that a value has been hedged and ledged into the system, and you have been given permission to utilize that. Now, your failure to take payment is our proof that there isn't a debt that's owed, and that's how you get remedy. So remedy is being made by making payment. It's not confrontational. It's not adversarial. See, honestly, and this might you got to listen to what I'm saying a couple of times. This is being recorded, so when after we talk about this in class, go back to this recording and listen to it about 7 times. It'll make more sense to you. When you appear in court, you're thinking that's your first appearance, and in reality, it's your first appeal. They already had court on the side of the highway. That was court. They was judge, jury, and executioner on the side of the road. Now, when you go into that room that they call court, that's not court. They're doing banking. That's why they're issuing charges, and these charges got to be bonded. The real court is where all of the judge's paperwork has to go. Where does the judge's paperwork go? Upstairs to the clerk. That's the real court. Your battle is always a commercial battle. And when you fail at the commercial battle, then it becomes criminal. You keep tongue wrestling with these people, it's going to become criminal. Everybody that knows this fact, this is why you will never, in most cases, ever have a proceeding where an acknowledged notary is in the same courtroom proceeding as a abiding magistrate. You know why? Because if you're a lawyer, don't they say you're practicing law? Lawyers are practicing law, right?
Yeah.
Okay. A lawyer is practicing law. So an attorney, he's a law practitioner. A judge, a lot of times, he's a bar member, so that means he's practicing law. Listen to how I'm saying it. Damn, if you got all these people practicing law, shouldn't it be someone on the team that already has mastered law? Well, guess who that master is? The notary. They're practicing to be notaries. Because the oldest legal practitioner isn't a lawyer, damn sure ain't a judge, it's the notary. The notaries have been doing this since the days of the Bible. The same oath of office that those judges and magistrates take is the same oath of office a notary takes. That's why all of the judges' paperwork got to go before a notary. So who has the authority? Under universal law, the greater has influence over the lesser. So if the judge is all powerful, why you got to send his paperwork to the notary? Because he's not. He never was. The only reason why they practice in law, you gave them the license to practice because you're incompetent in commerce. That's why they're doing all of this stuff.
That's the courtroom.
See, a lot of our people are actually victims of identity theft, and as a people, you're supposed to be in court claiming tributary taxes that's owed. They owe you a tributary tax. And the IRS is not your enemy. They're your best friend. They're your tax collector. They collect taxes on behalf of the creditors. If you claim a nationality but go straight into some other who shot John, they laugh all the way to the bank. Because they're saying you don't get it. When we do arbitration, when I read off the legal maxims, my favorite maxim is number 14 because it states it is tax fraud to go to court when you can handle this privately outside of court. Every person that takes you to court for whatever is committing tax fraud. But if you don't put them in the hot seat and you don't bring forth your bond, you just played right on into their hand. And every debtor loses in court. Debtors don't win when you go to court. Debtors lose. Creditors go to court for one thing, to get paid. If a creditor ever goes to court, they're going to get paid. They're picking up a credit. So there's rules to this thing. The real creditors will disagree in an arbitration proceeding because it's insured. If me and you don't get along and we fall out, we file an insurance claim on each other's insurance and keep it pushing. And it never makes the light of day. We handle it like gentlemen. We acting like belligerent debtors when, we hooping, hollering, screaming, and we want to sue. When you start studying commerce, why do you have the opportunity to sue? Is that the right of a righteous man to sue? Or is that the right of a corporate fiction to sue?
I guess a corporate fiction.
Okay. But see, when they give us all of the tools we need to save ourselves. When you go into that courtroom, that's not a court, it's a bank. They tell you to hold your hand and swear to tell the truth, the whole truth, and nothing but the truth. And again, if we're going to go into this conversation, the very first law book is the Bible, according to them, and they test you with that. Because if you putting your hand on the Bible swearing, you just failed right there. You're not supposed to take the Lord's name in vain. You're supposed to affirm. By responding, I affirm. Now I swear. When you start doing that, you're a debtor. You're a slave. You got nothing coming to you but servitude and debt. Slavery was agreed upon by all of these individuals to not be spoken. I ain't said it wasn't practiced. It's just not spoken. It's called a job. It's called servitude. It's called, go to school, get a good job. That's slavery. That's what it became. And now you teach it to your children. Go to school, get a good job. You ever thought about the fact that the people who's telling you to save your money in the bank, they ain't saving their money in the same bank? You ain't figured that out yet? The elite are not saving in the bank because they own the bank. Why do they need to save when you're doing the saving? But that's a different lesson.
Yes, it is.
But definitely, big bro, it's all commerce, it's all accounting. Any other questions? Anybody who has a question, please press 9-4 on your keypad so we can bring you on and see where you're at.
Hello?
I can hear you.
I have a question. You was talking about the insurance, and as far as like with me being a trucker, like I have truck over, I have insurance truck, but I don't think I have insurance over the company itself. So I'm really practicing. I'm not in order. Correct?
Okay. So if I'm hearing you right, all right, repeat that because you were sounding kind of low a little bit. Repeat that so I'm following.
Here in the trucking, like I have insurance over my truck, but not over my business. Should I be like, once we get off this call, be looking to get insurance over the business itself? Because then I'm out of order. Correct?
Right. You having the equipment insured, you're not that far out of bounds. But to be bulletproof, the business itself needs to be insured. And I'm gonna explain this. I'm gonna play devil's advocate. Having your equipment insured, if somebody break in, steal it, it catches on fire, you can go get another item to do business. So wouldn't it make sense that if somebody comes along and sabotages your business, sues your business, see, you don't have no insurance against somebody suing you. Remember, people in the public, they panic real easy. When things don't go right, they want to do what? Sue. So you have general liability to keep all that out of pocket. Why? Because we ain't going to go to no court. We finna handle this through arbitration, privately. You're going to file a claim, get paid, keep it moving. That's what's going to happen. Makes sense.
And then also, like with the diagram you were showing, with the person, when you have the insurance over the company and your equipment, you can go back and put some paperwork with that and get some of that insurance to keep your company.
Insurance is actually an investment, but you can't call it an investment until you're in the right position utilizing it. So when your insurance isn't being, a claim isn't being made, you're supposed to be treating it as an investment. So if you have $1 million general liability policy, you got $1 million investment, and all of those premiums are simply installments on that $1 million asset, and you can leverage that. So as long as you're practicing your business safe and soundly and no claims have been made, you can leverage that. Now, if you got insurance and you being sued and you got claims being made, your insurance going to be sky high. And you might need to change your practice because, you're bad business if claims being made every week. But there's a method to it. That's why companies who know this game, they play the what? The name game. They play the name, keep the name clean for 6 months, get some capital out of it, change the name. Play the game, pull some capital out. They do it every 6 months. There's nothing wrong with that. That's just how the system is designed. It's insurance and reinsurance. Any other questions? Okay, so we ain't got no more questions. Nobody ain't pressing 9 phone the keypad. Let's get dangerous then. Let's do this. Bring out my UCC book here. There's a particular chapter that I want to discuss. Bear with me while I find this particular chapter that I want to cover. And the said manual that I'm going over is available in our bookstore inside of our website. For those that may want to get their copy of this particular manual, please make the inquiry and I will make it available. Let's see. Yeah, there we go. Because we're talking about courts and we're talking about equity. And now we're going to talk about minimal contracts. But I think I'm going to start with the federal district courts. Here we go. Now, all right, so let's go in here. I'm going to put everybody back in lecture mode. Everybody's muted. Now, we're going to bring up, all right, and everyone should be able to see the federal district court heading on this particular PDF. We're coming from the, business law. Business law and UCC's 13th edition. And again, I'll provide the link for these manuals after class. For those of you that actually have this manual and you got your Chat GPT, man, you should be doing some. For example, I'm gonna read this to you, and I'm gonna walk you through a prompt. Again, I'm gonna read what I'm talking about, and then I'm gonna walk you through a prompt on Chat GPT that'll turn this into an entire process. Federal district courts. Each state and territory in the United States have at least one federal district court. These courts are known as the U.S. district courts. The district courts are courts of general jurisdiction in the federal system. Most federal cases begin in federal district court. Not all cases belong there, however. The federal courts have subject matter jurisdiction over 2 types of cases: those involving federal law and those involving diversity. Federal district courts have subject matter jurisdiction over cases that pertain to a federal question. A federal question could involve a federal question could involve the United States Constitution. It could involve a federal statute or statutes or a treaty. A state law issue could be included in the suit involving a federal question if the state claim is part of the same situation that created the federal question. If the federal claim is thrown out by the federal court, the state law usually cannot stand by itself. The people bringing lawsuits would have to take their case to a state court. Subject matter jurisdiction in federal court also arises in cases of diversity. Even when no federal law is involved, diversity cases include lawsuits that are 1, between citizens of different states, 2, between citizens of a state of a different state and citizens of a foreign nation, and 3, between citizens of a state and a foreign government as the plaintiff. This last method of establishing jurisdiction usually applies when a foreign government sues a citizen of a state. Let me stop right there. I got some Moors that I rock with from time to time, and it pains me sometimes to just sit there and keep my big mouth closed. I was the person who always couldn't keep stuff to myself. So when I hear my Moorish brothers and sisters make these elegant arguments about this, that, and the other, I always cringe because I remember my law professor going through an extensive breakdown on federal district courts, subject matter jurisdiction, and federal questions and diversity cases. And for the life of me, I couldn't understand how we'll pick what we want to pick from what we're reading, and we'll just totally disregard the other part that we, be honest with you, we didn't read. And this is where it gets dangerous. Before I just read about diversity cases, how many of you guys understood or ever heard about federal questions that could involve the United States Constitution? And again, press 9-4 on your keypad if you've ever heard of the federal questions, that govern whether or not a case has merits in the federal district. Is there anyone in this particular class that's ever heard of such a thing? Let's see. I think I got this. Let's see. Do we got Brother Mark? I got Monique on there. Let me see. I got Jarvis. Let me bring Big Brother Jarvis on. There we go. I ain't heard from him in a while. Brother Hunter, can you hear me?
Loud and clear.
Hey, big bro, have you ever heard of the federal question doctrine that deals with cases that may involve the United States Constitution?
Would that be on consular jurisdiction?
It could be, but keep in mind the way it's laid out. Let's go to a favorite one. Like, give me an argument that you hear a lot of people talk about that they got a right to do. I got a right. The Constitution give me a right. Give me an argument.
A right to bear arms.
Okay, the right to bear arms. Now let's bring that into the federal question. You do understand that the right to bear arms pertains to who? Who has the right to bear arms?
The actual citizen of the state.
The citizen of the state has a right to bear arms?
The national of the state. I'm sorry. Forgive me.
Okay. So if a citizen says, I have a right to bear arms, and everybody look at you like it sound good, I tell you what, you can have all the guns you want. Where's your license?
Exactly. And
Because
this is diversity of citizenship.
Exactly. See, if you are like, it's like your son, right? Your son in your house, right?
Yeah.
As long as you providing food, clothing, and shelter, he Tito, you Michael Jackson, right?
That's for sure.
Now, the minute he come in, he don't take out the garbage. He talking back to you and the missus, and he just being all unruly, still eating your food, taking the benefit, then it's going to get a little different when you take him to the first book of Jarvis, right?
Most definitely.
And you have to explain to your son, even though you love him, this is how the real world works, son. If you're coming, taking a benefit from me and your mother, then the rules we lay down aren't negotiable. Now, if you want to not abide by our rules, that means you can't take our benefit too. Probably going to have to go set your own abode out, and then you can hang out and not take garbage and do what you want to do, because that ain't affecting me and your mom commercially. We might not like it, but it ain't costing us nothing. We know you wasn't raised that way. Case in point, all the arguments fall all by the way, because under your rules of providing those benefits, you're expecting a certain what? Behavior.
No, definitely.
And the right to bear arms was for those individuals who were outside of government, knew that they didn't belong in that capacity, and it was their right to have arms in case y'all get crazy in government. You know, I have a right to bear arms to protect me from you, not to go hunting, but to keep you off my property. But if you're a citizen talking about you got a right to bear arms and you got a driver's license, well, that's more like a privilege. And a privilege, you know, if your son don't take out the garbage, can't you revoke his privileges to leave the house when he wants to? Since he can't take out the garbage, he can go in his room for a couple of weeks and figure it out. You know, either go in your room for a couple of weeks or take out the garbage when I tell you. It ain't hard. I don't think that's asking a lot. That's what government is saying. Like, you can buy a gun. I ain't saying you couldn't. I'm saying you're going to need to get it registered and licensed.
You're going to need permission.
Right.
That's what that's saying.
Right. Now watch this. If you have a business and you need to provide security for your business, now the rule work for you. Go out and get another gun. Get an AK. Hire a staff. Get some security. You got to protect your commercial property. See how that works?
Most definitely.
So the federal question and diversity of cases, we don't elaborate on that a lot because it's one of those taboo type things, like reparations. It's taboo. Somebody give me the thumbs up, like, man, you ain't gonna leave that alone. I was like, man, they keep bringing me back. It be calling me. Like, reparations go to a defeated nation. First off, y'all do know that.
Repair them for sure. Somebody got to give you some again. You got to suck on somebody's kid. Basically, they saying you want to be a dependent again. We got
right.
So
right.
Now let's cycle back up, because you know we failed. You know what I'm saying? We waiting on y'all to give up permission again to use y'all as chattel. You know what I'm saying? Under auspices that's determined by our the way we promote it, the way we project everything. That we'll do that for you.
Right, and you gotta remember, the people who are negotiating reparations, y'all check the channel now. who, Lord. if reparations are for melanated people, I don't know much about the space program, but ain't somebody melanated supposed to be negotiating reparations?
Most. I mean,
wouldn't it make sense? Like, you know.
Well, I guess they tried it under the Freedmen's Bureau, but they stole the funds.
Oh, Lord. Have we not learned?
How?
Hey, but I mean, that's where we at. So it's like, okay, reparations sounds good until it don't to me. And it's like during COVID, and nobody get offended. I'm just a messenger. I told folks when everybody was rallying about the Black Lives Matter movement, and you live in your town and city, and you see a van show up with people that ain't from your town talking about, yeah, Black Lives Matter. Y'all go to a rally, y'all get arrested. These people who was out there talking about Black Lives Matter, they done got back in the van and went to the next town. Y'all ain't figured it out yet. You get banned up and done caught a charge, they in the next rally. Y'all ain't figured that out yet.
Busting out windows.
Right. In your neighborhood. Listen to this. They come to you. They tear up your neighborhood and then leave.
Insurgents, for sure. That's what.
But I mean, it's. I just, I got a son that's out there in the A. He was wilding a little bit with that. I just told him, I'm like, son, I'm just telling you, like, you do what you feel, but all I'm trying to tell you is, if it's 8 of y'all from Decatur and 20 people show up and 8 of y'all from Decatur all get banned and the other ones that ain't from Decatur, they going to the next rally, you'll figure it out. You'll figure it out real quick, man. On your way to the meeting, on your way to the rally, you get stopped. The minute they say kill Whitey, you ready to go in arms. You better be careful. But I digress. Federal question. A lot of folks don't know about that proponent. Now, here's what I want to show you with that, if you will allow me. Let's take what we just read and let's quantize it. Let's make it applicable. Let's do something with it. All right. I'm going to attempt to try to share my screen and I'm going to open up in Banking in the Box, so it might stream it. Hope it will. Yeah. Let's see. I can't see anything yet. Okay, got the plugins. There we go. All right, now let's go. We're going to go federal courts. And I'm going to cover take this whole excerpt. Okay. All right, now let's share the screen so you can see this in real time. And we're at the part of the class where we're now doing some prompt engineering. These data sets are available on our website for those that are in need of these data sets, so please make it known, and I'll make them available. All right, let's see now. Can you see my screen? All right. Can you now see my screen?
Yeah.
All right. If you can see my screen, then just pay attention because you just might learn something. Right. This is from the excerpt that I just read in that particular manual. If I did this right, we should get a result. And as you can tell, not only are we getting a result, I prompted the role of the ChatGPT to take the role of a lawyer and take that excerpt and break it down into a detailed, robust outline. Now, in this outline, it has created an introduction. It broke it down into jurisdiction. It actually gave it subcategories. We're going to say categories 1 through 4. If I wanted to totally make what I just read applicable in arbitration, I would prompt the AI at this point to execute each of these steps. Something like this. Picking a typo, but bear with me. If I did this right, we should get a result. Let me clean this up a little bit. I just noticed something. Wasn't clear on my instructions. I need to be a little bit more cleaner. So, I'll go back into this. Now let's try that again. Okay, now because of these plugins, I want that same prompt, but I don't want it to create an audio. I literally wanted to give me the definition. So let me try it. Let me try the prompt a different way. This might work, may not. Let me see. I'm trying to do it a different way. Okay, I got to change the prompt. It's going to keep giving me the audio. I don't want the audio. All right. Let's take. We'll take this outline. I'm going to copy the outline. I'm going to start a new thread. I'm going to get rid of one of my plugins, the one that is trying to generate the audio, because at this point I don't want audio. So I go to my plugins. I'm going to disable this one here that gives me the audio. Get rid of that one. All right, let's try this. Now I'm going to get crafty with the prompts. Using this outline as a reference, so I'm going to give it the outline. Which one I want to execute. All right, let's try it now. If I did this right, I should get a result. There we go. There we have it. See, creating a new thread gave me the opportunity to repetition it. And when you put it in this type of format, I can literally go through this entire outline and ask to execute each step. I told it execute number 1. Now I'm going to repeat the process with execute number 2. Which typically what I try to do is I copy the whole format of what I want to execute it. so I don't make no mistakes. And after I get enough of the stuff inside of the thread, it'll actually start partitioning it itself. All this was just off of that one paragraph that I copied. I asked it to actually execute breaking down jurisdiction of the federal district courts. It says subject matter jurisdiction refers to the type of courts, cases of court, and is authorized to hear. Federal district courts have subject matter jurisdiction over, and it gives me the examples. It breaks down the federal question jurisdiction, case in point. So I got, that's 2. So I'm going to say execute 3 and 4. If I did that right, it should follow suit and continue to generate. And there you have it. Understanding how to utilize the prompts, which are AI tool, takes whatever data that you have and it literally puts it on steroids. And I want to just demonstrate that in the aspect of class so you kind of understand you're only limited by your resources, your tools, your data. And you can take this data. Now that I have an outline and it's explaining all this stuff, now I can actually take this and implement it into an arbitration case. And I can actually make these bullet points reference points. If I want to totally style a case right after what we're actually reading, then I have the blueprint to do so. I hope this is making sense to a lot of folks. Look, I got a lot of stuff I would like to inundate in that regard. See, I got a question here from, I think, Brother Allen. Brother Allen, you got your hand raised, big bro? Mr. Allen, do you have your hand raised?
I did, but really I was going to ask about something else, but I'm listening to what you got right now.
Gotcha. No worries.
My question was about treaty.
Mm-hmm. Oh, it was about what?
Treaty from the federal court question. Yes.
Gotcha.
If you got a treaty.
Mm-hmm.
If you got a treaty, all right, like a treaty that is set between America and Ethiopia, and that treaty is supposed to have you in mutual enmity between Ethiopia and America. That treaty also set us as a high contractor party. How do we execute that in terms?
Basically, you would have to bring the treaty in unison with the commercial codes that grants you the ability to do those things. For example, look at a treaty as a declaration, which gives you the ability to do so. But you need to attach to it the proponents that lines up state, federal, and local commercial code in unison. In other words, if I want to simply act under a level of immunity under treaty, then I would style that verbiage in unison with commercial code, uniform trust code, and local and municipal laws. In other words, I would reference those things as statutes of immunity. I would reference the Uniform Commercial Code UCC 5-115 that gives you the right to a right for to be indemnified. Right of indemnification is what it's called. Under right of indemnification, treaty definitely falls into that. Now, in enforcement of treaty, are we trying to recoup something to make the state back whole? Are we trying to protect rights under treaty? It's all about now execution. So that, one part of it would acknowledge it, meaning bringing it back in alignment with the code, and then the other part would be to commercially convey.
Okay.
So, because they acknowledge commerce, they acknowledge the right of indemnification, and it's not about just one party being indemnified, all parties being indemnified. The only reason why, and we have to literally prejudge the transgressions of one territory or country over another as a matter of, how can I say it? They are a ship that is in a very small harbor. So if they make a turn, they're going to run into a smaller ship. They have to, because they got to make this turn. And so it's custom that if they make this turn and they brush up against your boat, you're going to be compensated. So they're trying to make the turn with least amount of traffic and least amount of goods as possible, so they don't have to pay as much. But every time they make a turn, they have to pay. Tributary taxes work that way. They're collecting all of these taxes from debtors supposedly to convey for the damages that they create, but we never make a claim. So they damage us commercially. We don't make a claim, and they're, we're keep being damaged and not being, being fulfilled commercially, and they're mistaking our acquiescence as consent. When you don't make a claim, it's the same as consenting, and he who has consented can receive no injury. So the execution of treaty is rooted heavily in your ability to execute upon an Article 9 security interest in said treaty.
In other words, how you make a claim.
Right, you need to make a claim saying, look, this under treaty, these things were violated, and I have literally effectively, hedged this claim in, under commercial activity. Now you're forcing those individuals and entities that are bonded into involuntary bankruptcy. You don't have to wait for anything. You just have to now take control of those indemnities that are there. To wait for them to give you something is too much like wishful thinking and the right thing.
Next move you will do is what? Liquidate their assets and transfer it? Then transfer the collateral?
I don't have to transfer or liquidate the collateral. I can simply hedge and ledge it, because we live in a world of credit and commerce. I just simply need to learn how to, I convey it commercially. If the government owes me money, then I'm never broke, and that's what I use to take down Elodio assets. I leverage the debt, and I insure it and reinsure it.
So how much years it take before you can go back on a claim if they owe you?
Well, it depends upon who you are in the transaction. If you are a citizen, I'm gonna say unequivocally, a UCC-1 needs to be renewed minimally every 5 years. If you're not a citizen, then there's no limit to how far you can go back. But if you are a citizen, I'm gonna keep it in the construct of UCC, and you have to at least renew it every 5 years.
Okay. That's interesting.
But that'll be an ideal position, in my opinion.
Understood.
All right. Any other questions? I think I got Miss Fleming. I just seen her hand just raised. Let's see. Miss Fleming, can you hear me?
Again, you over here killing me.
I'm sorry. I'm sorry.
I need to get some clarity. On the estate, the 98 number.
Right.
Because we were talking about differentiating it from the actual family.
Right.
Trust. Is that a receivership or a survivorship? I mean, a SIP or a settlement fund? And I'm asking because that's what the site is asking me.
Right. You would literally, if the estate. All right. So let's define the estate in this regard. Receivership. What exactly would the estate be receiving? Because
all of the tax credits from everything, all of my commercial energy.
Okay. All right. So tax credits can be dispersed. They're fully conveyable and transferable. So that's not a jurisdictional question. That's not a taxable jurisdictional liability. So if that is what's actually being received, then you can get away with either or, because neither would put you in the hot seat. Now, if the receivership does consist of M1s, then some documentation would probably, in my opinion, be necessary. Yeah, at least an operating agreement showing how those assets are actually being used.
Okay. And that
key
would
to it
be,
is right.
That
You
would
can
be,
author.
That would be put into the receivership operating agreement.
Right, and you can author whatever change, provision, or right that you would like to use. So you're never limited by one person's narrow thinking. If you want to do it wearing a yellow skirt and a tiara, you can. It doesn't matter what. No one can say you can't if you've already authored that in your document.
Okay. Okay, very good. That was my other question was you had placed something in Bitrix regarding new accounting principles.
Yes, and if you've seen that, we need to have I'm going to do a class on de-aggregation.
Okay.
De-aggression is what it's called. The term that they hit us with this morning was they're going to be using disaggression to leverage out of balance income statements. Right. It's a very I gotta get a devil is due. It's pretty slick.
Really? Okay.
It's like if it's a company that has to take the liability, you're kind of saying, well, I know when you make your report, it's going to sting.
Yeah.
But if I go opposite, it won't sting as much. And if I can talk to two more people, it won't sting at all. If I talk to a third person, you just got to agree after swelling go down that we're going to straighten everybody out. It gets real interesting. I listened to these different scenarios, and I was like, wow, so if everybody agrees to help this one entity, then by the time you get to the fourth entity, you're still conveying. It's like I have to give the elite, I have to get a devil's due. They're never going to change their behavior. They're just going to come up with a new rule.
Right.
And so with that, it will definitely be something that, especially you guys that are doing your leverage buyout strategies, you're getting in more into managed buyouts, putting the right team together for acquisitions and so forth, it gets real interesting. So I would like to reserve at least a whole class to go through that as I think about it.
And when will we be sitting down through our audits?
Actually, those are being scheduled as we speak. I think you are already in queue. Jarvis is in queue. I got a couple more. So the sitting down and the one-on-ones are basically us going over your syllabus line by line, making sure the math is right, and then knowing which instruments you want to style. Because once we do that, I'm overnighting the actual information to you, the physical specimens.
Okay, perfect. And then as far as setting up the seller as the beneficiary, that is the position we're taking right on in my case.
Right, exactly. Okay. That's the preferred method. That is the preferred method. So I usually start all processes in that level of protocol. I will eventually entertain different things, but that gives us total autonomy and control that way.
And did you happen to get a request from the title company finally?
I did. I got a request, and so all we're doing now is basically strategically laying out the rules of the road for closing, which, in my opinion, I'm pushing for us to just arbitrarily close it. It's painless that way. So we're just trying to make sure that everybody's on board with that.
All right, perfect. And I just need my FASB book. I'm just saying.
Oh man, see, I'm gonna make sure you get that today. I suppose they got it yesterday. I apologize. I had to stop class early yesterday, but but I will definitely make sure you get it today.
Because now I totally get wrapping that accounting, wrapping the FASB codes around our narrative and it really driving the ledger.
Correct.
So,
correct.
Thank you. That's all I have.
All righty. All right. Let's see. Brother Hunter, can you still, I think you should be able to unmute yourself. You got a question, bro, or you just had your hand raised from previous?
No, that was previous.
Okay. Got it. Did we got any more questions, comments, or concerns over anything we covered in today's proceedings? Press 9-4 on the keypad if you got any questions.
Yeah, you was getting ready to read something about the federal.
Right. I was about to talk about the USDA, so I'm going to try to see if I can get that in as well. So let me see if I can do that. So just bear with me. Let me put everybody back on mute and bring that forward here. All right. Let's take this down a notch here. Okay, so here we go. All right, I got quite a few things about the USDA. We talked about the leveraged buyouts. I'll start with the de-aggression of income statements and then go into the USDA. All right, here we go. Let's see here. All right, so we're kind of going to go into what I was told this morning and then go into the USDA. Now, this is fresh off the press of the Financial Accounting Standard Board in reference to a meeting, a debriefing, if you will, that we had this morning. And this debriefing deals with the disaggregation of income statements expenses, dealing with the proposed accounting standards in an update. It says in this article is aimed to provide a comprehensive overview of the disclosure requirements in the proposed accounting standards update for disaggregation of income statement expenses, otherwise known as DICE. So the new acronym is DICE, D-I-C-E. The proposal was issued by the board in response to requests from investors for more detailed information about certain types of expenses, including in the expense citations commonly presented on the face of the income statement. Here's a little background. Before diving into the proposed update, let's understand the current income statement presentation requirements for public companies, particularly those in the manufacturing sector. Currently, there are relatively few specific income statement presentations requirements in the codification and the citations used and generally established by the SEC, which is the Securities and Exchange Commission. As a result, there's a significant variability in how entities labeled and present expenses and citations. The scope of the proposed guidance brings forth a proposed update which will apply to public business entities, which include public companies filing or furnishing financing statements with the SEC. It does not apply to private companies. It doesn't apply to not-for-profit entities. It does not apply to employee benefit plans. The update would require disaggregation of expenses citations that contain at least one of the following natural expense categories. So if you are not one of these, quote unquote, if you are a private company, you don't have to do this. If you are not for profit, you don't have to do this. If you are an employee benefit plan, you don't have to do this. So if you are one that has to do these is what you got to start including in your expenses. You need to have a label that spells out inventory and manufacturing expense. You need to have a category in your ledger for employee compensation. You need to have a category in your accounting for depreciation. You need to have in your accounting, hint, hint, notaries, intangible asset amortization. You need to have depletion and amortization from any type of asset such as oil, gas production activities under DD&A. So, based upon what type of entity you are, you need to have one of these 5 additions added to your citation ledger. Disaggregation of expenses and amounts. The proposed update outlines how expenses should be disaggregated for each of the required natural expense categories. For example, the cost of products sold, the cost of services, the selling, general, and administrative expenses, which we refer to as SG&A, are likely to be relevant expense captions requiring disaggregation. On the other hand, interest expense and income tax expense may not need to be disaggregated since they do not contain any of the required natural expense categories. The following amounts are proposed to be disclosed for each required category. You need to do depreciation and amortization, which is currently required to be disclosed in total, but the proposed update requires disclosure of the amount included in each caption presented on the income statement. In other words, do the depreciation, reflect that depreciation on an income statement. Next is the employee compensation. Currently, this is not specifically disclosed, but the update proposes to disclose the amount included in relevant expenses. So, if you are a publicly traded entity, you need to have a category on there for employee compensation. But if you happen to be a trust and you're paying them with a 1099 NEC, you don't have to disclose that. Under inventory manufacturing expenses, we're dealing with currently recognized entirely within the cost of products sold. But the update proposes to disclose the amount separately. Additionally, certain existing disclosures should be integrated in the same tabular format as the proposed new disaggregation requirements. This applies to amounts recognized in only one expense caption and to amounts where both the amount and the corresponding income statement captions are currently required to be disclosed. The proposed updates include lists specifying which existing disclosures should be integrated if applicable. Now we come to the quantitative descriptions for non-required categories. As the board decided to focus the disaggregation requirements on specific expense categories requested by investors, they may be on the other amounts in each relevant expense caption which do not fall within the required categories. For these amounts, the board proposed a quantitative description. The example in the proposed illustrates the qualitative description of the amounts remaining in each relevant expense caption, which are shown as footnotes. What do I tell anyone? The most important part of any finance statement is the footnotes, and let me give you the conclusion. The proposed accounting standard update for disaggregation of income statement expenses, known as DICE. So you need to have on the bottom of your accounting the acronym DICE, in conjunction with CECL, which is current expected credit loss provisions. As long as you put that at the bottom of your income statement, you're able to go back and decelerate liabilities. Hopefully this made a little sense to you. If you want a more direct, fundamental, yet complex explanation, feel free to give me a call at the office at 407-792-2774 between the hours of 9 and 5, and I will do my best to definitely get you a more in-depth explanation. But you're going to hear more about DICE as we get closer to the deployment of this central digital banking currency. Keep in mind, the two are tethered and they're in tandem. Last but not least, we now come to what was being given to us in the new USDA loan program. I have put a lot of information up in the Bitrix pertaining to the USDA loan program, especially for those of you that are brokers with North Avenue Capital, which held a exclusive webinar today that was pretty much standing room only. I wasn't actually able to get into the meeting directly, but a couple of my constituents did kind of give me the fly on the wall presentation of what they talked about, which typically gave us the advantages. So let's talk about the advantage of the USDA. First of all, they have right now a zero down payment program. This is the most significant advantage of the USDA loans, which is absent of down payment. Unlike conventional loans, FHA and VAs, where down payments can range from 3 to 5%, USDA loans require no down payment, making home ownership more accessible. The meat and potatoes of USDA are in this capacity. The basics are USDA loans allow 0% down payment, making homeownership more attainable. They come with low interest rates, mortgage insurance compared with conventional loans, and there are two types of USDA loans. You have USDA Direct and USDA Guaranteed. USDA Direct is for low-income individuals and is offered directly through USDA's website. USDA Guaranteed is available through various lenders, including our company, which is North Avenue Capital. Key point. The eligibility and geological restrictions are as follows. USDA loans are for rural areas, but the definition of rural is based upon population size. Many areas that qualify for USDA loans are just a short commute away from larger urban centers. USDA loans are not exclusive to first-time home buyers, so you don't have to be a first-time home buyer to deal with USDA. They're offered by the United States Department of Agriculture to support population growth in rural area regions, and the approval is based upon a system called Guaranteed Underwriting System, or GUS, which stands for which is a government-backed software that assists in loan applications. So you know that software I just showed you at the beginning of the class? Well, LoanDisc has a proponent for GUS. So if I can get it on a UCC, get it inside the portal, and get that securitization audit scheduled, then you're on your way, preferably, to a USDA loan if that's one that you're looking to acquire. For more details, feel free to reach out to my office for more exclusive details. I will say that some of the credit score and credit events that they did discuss, minimum score. Now listen to me real carefully, because this is where we're at. The minimum score for USDA loans is 500, though some lenders may want a higher requirement. 640 is ideal. So let me explain this to you. If you have a 500 score and only 10% of your disposable income is going towards expenses, we'll take the 5. If you're spending more than 10% of your disposable income, they're going to probably require you to have a little, you don't have to have stronger credit, because it's about your debt to income ratio. They don't want to put you in this loan and you can't afford to make payment. And only 10% of your disposable income is supposed to be applied to that. And if you don't understand how you can accomplish that, this is why you bring forth those insurances to reduce your liability. Again, more in-depth intel, please feel free to reach out to me at 407-792-2774 between the times from 9 to 5. And someone from my office will definitely get with you to give you more exclusive details on the new USDA program. I hope that everything that we have discussed in today's class has been insightful. I hope everybody has learned something. And again, if I am to be of assistance, I'm only as good as the questions that I'm asked and the direction that we're in. So please feel free to reach out to me. Drop your question inside the Bitrix. I look forward to working with you guys. I appreciate everybody's time and energy. And with that, I'm going to say peace and love, family. Peace and love.